Hi friends, welcome to Adda 24/7. Hi, today is the marathon for BFM and we'll be solving the objective questions in the same. Okay, plus at the end we'll be doing the numericals also, case studies. Okay, so don't miss anything. It'll be roughly for 1 second. Yeah, it'll be roughly for 3 hours, roughly 3 to it can go for 4 hours also. Okay. So don't miss even a single piece, single second of this because we'll be solving, I'll show you here. We'll be solving the important objective questions which may be asked in the exams. Right from the one-liners to the case studies as such. Here I'll be showing you some case studies at the end for horizontal and vertical disallowance also. Remember, this disallowance queries are asked almost every time in the exam nowadays. Okay. So everyone's okay, ready? Let's join. Okay, let's start. Okay. How many of you are ready for this BFM exam? Okay, how many of you are appearing for this BFM exam now, this Sunday? Type me in the comment section. Those who are appearing for the BFM exam, type me or yes in the comment section. Everyone. Yeah. In the meantime, I'll start. You just type it. In the meantime, we'll start with the first question. So, the first question is, which of the following features of the derivative is not correct? Okay. One sec. Which of the following features is not correct? Okay. Just read this. Yeah. Which of the following features? Derivatives are instruments that mature in future. Derivatives help to neutralize the risk to the acceptable level. Derivatives derive value from the market conditions and none of the above. Now we want not correct. Okay. Remember, what do we want? Here, in exam, you have to always focus on what is required. Okay. Yeah. Almost everyone, yes, all are appearing for this BFM exam. Good, good, good. So you are on the right track now. So now, let me come to this question. Hold on, hold on. Yeah. Are you able to see this? One sec. Yeah. One sec. It's some, you're not able to see this? Let me see. Let me adjust it a bit. No, okay. One sec. Not able to see this? Hold on. No, you should be able to see this now. Yeah. Yeah. So which of them is not correct? Here, derivatives are instruments that mature in the future. Derivatives help to neutralize the risk to the acceptable level. Derivatives derive value from the market conditions and none of the above. So we want not correct. Huh? Always focus on what is asked in the exam, not on what we know. Okay. So derivatives derive the value from the market conditions and instruments. Derivatives are instruments that mature in future. Let me see what is the answer given by all. A, B, B, B. Okay. D. Okay. D. Okay. So let's see this. So the answer over here is which of the following features of the derivatives is not correct. So derivatives are instruments that mature in future. That is correct. This one is okay. Derivatives help to neutralize the risk to the acceptable level. That is also correct. Derivatives derive the value from the market conditions. Now this is also correct. Okay, so all of them are correct here. So the correct answer is D. Not correct is this D. Because here derivatives value always depends on the market conditions. What is the present market situation? Okay, it always depends on that. Got it? So which of them is not correct? None of these. All of them are correct. Okay, let's move on. Hold on. I'm just doubting if you are able to see the question properly or not. Hold on, let me see. Let me see the second one. Yeah. Are you all guys able to see the question properly? Second one now. Yeah. Are you all guys able to see the question properly? Type yes in the comment section. If yes, now I'm in the second question. Yeah. Second. Okay, yeah. You are able to see this? Okay. Chalo, next one. Which of the following is a derivative instrument in foreign exchange market? Forward contracts, currency options, currency swaps, FRA means forward rate agreements, and last one is futures. Futures. So which of them is a derivative? Now is a derivative. Yeah, first question was not. Here it is a derivative instrument. So which of them is a derivative instrument over here? Look at this. Derivative instrument. Forward contract. Is it a derivative instrument? Currency options. Is it a derivative instrument? Currency swaps. Derivative instrument. FRA. Derivative instrument. Yes. Futures. Let me see the answers from your side. Yeah. Okay. Yeah. So what is the answer over here? Forward contracts. See here, in fact, remember, derivative instruments means all of them are derivative instruments. Forward also, currency options also, currency swaps also, FRAs also, and futures also. Okay. So all of them are the derivative instruments. So answer is D, 1 to 5 all. All of them are the derivative instruments. Okay. All of them. Second is D. Okay. Okay. Next one. Derivatives is used for. So derivatives is used for what? Okay. Derivatives is used for this one. So it is used for what? Making profits, eliminating losses, managing risk, and all of the above. See here, for your CAIIB, we have to study from your CAIIB perspective. Okay. From your CAIIB perspective, you might be seeing many of them dealing in derivatives for profits. We might be seeing them dealing in means profits for these. We see these call options, put options being traded in the stock market, but that is done for profit. So that can be the answer. But remember, from your CAIIB perspective, from your exam perspective, the correct answer over here is, now that's what you have to think: making profits, eliminating losses, managing the risk, and all of the above. What is the answer over here? Third one. Third is D, all of the above. Okay, many of you are saying, okay, all of the above, all of you are, many of you are saying, but one answer I've got it, C. Sirisha, you're right. C is the answer. Sirisha, you're right. See here, you have to study derivatives from your exam perspective, from your CAIIB perspective. Remember this, okay? We don't have to study from the profit making perspective. Derivatives are used in CAIIB for, do we have CRAR 11.5? It is 11.5 now, Komal. It is 11.5, okay? You have to add that buffer also. I'll come to that, okay? Derivatives are used for, firstly, remember question number third, answer is C, managing risk. You have to study derivatives from your exam point of view, from your CAIIB point of view. You don't have to study derivatives, okay, from the practical point of view. See here, Practically, derivatives are used for making profits. But here we are not into that. Okay. So that's why everyone, okay. In the meantime, has everyone liked the video? Everyone liked the video first? Like the video, subscribe to the channel. Everyone do the subscription, click on the bell icon. Okay, because you will be getting many other videos as such. Tomorrow also we are having one more marathon. So that marathon also you will be able to get it, and you will get the, once you click the bell icon, you will get that marathon also. Okay, you will get the videos immediate. Notifications are received. Okay. Chalo. So the answer over here is C. Eliminate, managing the risk. Okay. Managing the risk. Here, eliminating losses is never the answer, because you can never eliminate loss. You can never eliminate loss in any trade or any forex transaction, any banking transactions. Okay. So B can never be the answer. Making profits is not the answer for CAIIB. Managing risk is the only one thing. Now I'll tell you how to manage that risk. One thing I'll tell you, I'll write it over here. Here, how to manage that? Let me write it. So always remember this basic fundamentals. Okay, what is that? It is whenever you have a long position, okay, position. Always whenever you have a long position in commodity, always buy the put option. Put option. Remember this by heart for your exam. Long position in commodity, you'll always buy a put option. Okay. Good evening. Always remember this. Long position in commodity, you'll always buy a put option. Put is always reverse. Put. What is put option? Okay. Type in the comment section. Put option is for buying or selling. Type in the comment section, everyone. Put option is for buying or selling. Tell me that first. Put option is for buying or selling. Yes. Everyone. Put option is for buying or selling in the comment section. Correct? Put option is for selling. Always remember selling. Okay. Put option is for selling. Under put option, you get the right to sell. You get the right to sell. Okay. But not the obligation. Not the obligation. Okay. So long position in commodity, you'll always buy the put option, and reverse case is also true. If you have a short position in commodity, you'll always buy a call option. Okay. Chalo, move on. Next one. An unplanned event. Let me see. I always have to see if the questions are visible to you. If there's any problem. Yeah. An unplanned event with financial consequences resulting in loss or reduced profit is called as an unplanned event with financial consequences resulting in loss or reduced profit. So that is called as what? Loss, reduced profit, risk, or derivative. Unplanned event with financial consequences resulting in loss or reduced profit. So question number 4. Everyone. 4 is? Yes, very good. Very good. Question number 4 is C. C. Correct. An unplanned event here. What is the risk? Everyone, first give me the answer for the risk. What is the risk? The risk means, suppose if I ask you one thing. Okay. If I ask you one thing. In risk, okay, let me ask you one important part. In a risk, tell me, suppose if somebody stands in front of a running train, okay, stands in front of a running train, okay, is it a risk or not a risk? Okay, yeah, that only I wanted. If somebody stands in front of a running train, is it a risk or not a risk? Everyone. Somebody stands in front of a running train. Is it a risk or not a risk? Correct? Somebody stands in front of a running train. Is it a risk or not a risk? It is. It is no risk. Correct? It's not a risk at all. Not a risk. It's not a risk. Why? Because you know that person is going to die. If somebody is jumping from the 5th floor, okay, if somebody is jumping from the 5th floor, 10th floor, you know there's no risk involved in it. Risk means what? It is an uncertain event. Remember this BFM, you have to remember this concept of risk. Risk will always be an uncertain event. Let me write it over here. Risk is always an risk equals to uncertain event. Uncertain, this is very important word. Uncertain. Whatever you know is going to happen is not a risk at all. Okay? Whatever you know is going to, suppose if okay, one more question. I'll give it from the finance perspective. Suppose if I invest in all those Ponzi schemes, right? What those Ponzi schemes are? That invest 10,000 and get 20,000 in 1 month, 30,000 in 1 month. We have all those schemes. So we regularly get those schemes in our mobile also, that SMS and WhatsApp, many messages we get it. So if I invest in that, it's sure that I'm going to lose money. Okay, so that is definitely a point for consideration. Okay, so risk should always be an uncertain event. Risk should not be a certain event. Okay, suppose now I'll give you an example of risk. What is risk actually? Suppose if I invest in stock market. So investing in stock market is a risk. Why? Because I don't know. That stock market can go up or hera fairy, correct? Ekkadabal, right? That what was that? Fir hera fairy. Anyone remember that? Akshay Kumar? No. Tata Tech IPO was a risk, a bit a risk. It was there, but after all, investing in shares is a risk. It's as simple. Okay. So that is a risk because you may get upwards or you may get downwards also. So that is a risk. Okay, let's move on. Okay, hold on. Yeah, next one. When the sale of the foreign currency is more than the purchase of the foreign currency, this will lead to close position, long position, open position and short position. Now this is really difficult. When the sale of foreign currency is more than the purchase of the foreign currency. 5th one. When the sale of the foreign currency is more than the purchase of the foreign currency. Okay. So it is what in that case? Sale is more than purchase. Now here comes an important concept that I'll be explaining you. Okay. One concept which I'll be explaining you over here is this. Okay. When the sale of the foreign currency is more than the purchase, now you come to this position which I have discussed just now. That is long and short. Okay, what is long and what is short? Now you understand this long and short concept. Okay, what is long concept? See here, there are two concepts in long and short. Always remember. From the portfolio point of view, see here, there are 2 points. Okay, portfolio angle it is when my purchase is more than sales. When my purchase is more than sales, okay, then it is under portfolio, it is called as long position. Means, for example, I have purchased, let's say, 100 bonds. Okay, I have purchased 100 bonds and sold, let's say, 70 bonds. So what has happened? My purchase is more. So then it becomes a long position. Now this is for portfolio. And for individual, what is long? See here, individual, suppose dealer in this BF in this treasury. For individual, what is long and short? See here, individual means it is, suppose if I buy any share, okay, then it is a long. Keep it that simple. For individual, one share I am talking, one share, one bond, anything. For one bond or one share. When I buy, it is long. When I sell, it is short. Okay. Now, what do you mean by this shorting? Understand this shorting concept first. What is shorting? Shorting means it's like this. What is shorting? Shorting means See here, understand this now, shorting. This is very important from your perspective. Shorting means what? Sell when you don't have. When you don't have it. Don't have it. That is shorting. Sell when you don't have it. Means what? What do you mean by this? See here, if tomorrow let's say Reliance share is at 2500. Reliance share is at 2500 and I'm expecting that Reliance will go down. See this, Reliance is at, let's say, it's an example. Reliance is at 2500. I'm expecting it to go down to 2300. Okay. So I'm expecting it to go down to 2300. Okay. So now what do you mean by this? See here, what will I do? I'll sell these Reliance shares right now. I'm not having any share, but I'll sell 100 shares right now. And what happens? When it goes down, after let's say 2 hours, 3 hours or 1 day, if selling is allowed, short selling is allowed in the markets. So if I'll sell this 2500 right now, and when after 1 or 2 days, whenever the share goes to 2300, I'll buy it. Same 100 shares. 100 I've sold, 100 I'll buy. So what happens now in this case? Yeah. What happens in this case? I have gained how much? Here, I have sold it at 2500. I was not having any share. Okay. I was not having any share. Then also I have sold those shares at 2500. Okay. And then what am I doing? I am buying this again at 2300. So I am gaining around 200 rupees per share into 100. So 200 into 100, 20,000 I have gained when I didn't have any share. So this is known as the short position. So short means what? Sell when you don't have it. Important point for this short position. Okay. Chalo. Move on next. So got this everyone? These concepts should be very clear. What is the long position then? Long is simple. Buy now, sell later. Okay. Chalo. Let's move on. This one. Now this will be easy for you, I think so. Yeah. It is same question repeated. Okay. One sec. Move this here. When the purchase of a foreign currency is more than the sale of the foreign currency, it is known as, now this is simple. Answer is B. That's why I have given the answer also, long position. Because just now you have done this short, so now long is easy. Move on. Next one. If there is an appreciation in the foreign currency rates, in which of the following positions the bank will incur a loss? So, if there is an appreciation in the foreign currency rates, in which of the following positions the bank will incur a loss? Now, appreciation, remember, bank is having, rates of the foreign currency are going up. When will bank incur a loss? One is closed position, B is long position, C is open position, and D is short position. D is short position. So when will bank incur the loss? The currency is going up. Okay. If there is an appreciation in the foreign currency rates, so when will bank incur the loss? Think over it. Tricky one. Huh? This is a bit tricky one. This is a bit tricky one. Everyone think over it. I'll just give you one or 2 minutes for thinking. Okay. So the answer is correct. Many of you have answered it correctly, but some of you have answered it wrong. Here the answer is short. When the currency appreciates and you are in the short position, you will definitely incur a loss. When the currency appreciates and you are in the short position, you will definitely incur a loss. Okay. Short means what? You have more, you have sold more. And when you have sold more and the rate goes up, see here, appreciates means what? Rate is going more. Now you have sold more. So I have sold, let's say 100 shares, and now the rate has gone up. So I'll have to buy at a higher rate. So that's why I'll suffer a loss over here. Okay. Next one. If there is an appreciation in the foreign currency, now this is simple one. Once you have understood the first one, this is simple one. If there is an appreciation in the foreign currency, in which of the following position the bank will make the profit? So answer is so simple now, isn't it? Long. This you will understand it immediately, isn't it? In which one will the bank make the profits? Obviously. Let me see how many of you are answering what. B, correct? Chalo, move on. Next one. Simple one this was. To reduce the exchange risk, the bank puts in place the following types of limits: day limit, daylight, overnight limit, single deal limit, trading position limit, volume limit, and stop loss limit. So which one will bank put this? Or is it, here, what are the options? 1 and 2 only. Okay, 2 and 4 only. Next one is what? 3 and 4, 3 and 5 only. 1, 3 and 5, and 1 to 5 all. So what will the bank put in over here? C. Many of you are typing C over here. C. 1, 3 and 5. What is 1, 3 and 5? Daylight, overnight. 3 is what? Trading. And 5 is stop loss. Okay. What about 2 and 4? Correct? The answer should be, everyone look at it, the answer should be D, 1 to 5 all. Why? See here, daylight limit means what? What is the daylight limit? What is the overnight limit? See here, overnight limit's other name is EOD position. See here, remember this. Daylight means daylight. It is equal to the day position. Whatever, see here, for example, in our bank also, we have the cashier. Cashier does the whole job of taking and giving the cash in a day, but this cashier also has a limit for the day also. Suppose if any cashier tomorrow brings in 5 crore rupees in his cash this cash section and starts dealing with those 5 crore rupees, will the bank allow it? No. Bank allows you to take some part of this cash on a daily basis, depending on what all is the daily volume, right? So this is known as daylight limit. So daylight limit will always be there. Second is overnight limit. So daylight means what? During the working hours. During working hours. This is known as daylight limit. Working. Okay. During the working hours. This is known as daylight limit. What is overnight? Here, overnight limit, the other name is overnight. Other name is EOD position. EOD. Okay. EOD position. One sec. Let me take it on this side. Okay. Yeah. Now it's visible. Correct. So, firstly, increase the font. Font is okay, na dear? Any problem with the font? Let me see. Let me cover all these fonts. Let me see. Yeah, we are over here now. Shobna, just check it now, whether the font is okay for you now, everyone. I think so, it's visible. Even this font was visible. I've just increased the font now. Yeah. Okay. I think so, even this is visible. Yeah. Okay, yeah. Okay now? Chalo. So what is overnight? This is also known as EOD position. So remember, the long and short always comes at the overnight position, long and short. Okay. What is single deal limit? Single deal limit means per deal what the trader can do the transactions. Suppose if any trader tomorrow starts dealing with buying the bonds of, let's say, 100 lakhs, 100 lakh dollars. So that won't be allowed. Every trader will be given a sub limit as such. So this is known as single deal limit. Trading position limit. Trading position means, trading position always refers to either long position or short position. Long position means how much can you keep long, how much can you keep short. Suppose if any trader tomorrow starts buying the bonds, okay, buying the bonds heavily, okay, in that case what will happen? If the trader starts buying the bonds heavily, in that case what will happen? In that case, the trader, if the rates of the bonds fall down, go down, then the bank will be in trouble. So that's why every trader, everyone has to be given a certain limit. Similarly, volume limit also, similar logic, volume limit, okay. And last one is stop loss limit. Stop loss limit is of utmost importance to you. You'll definitely get one question on stop loss limit. What is the stop loss limit? Understand this thing, stop loss. Okay, what is the stop loss limit? Stop loss means, always remember, stop loss is that point which is automatically triggered. Automatically. Okay. What do you mean by automatically triggered? It means here, suppose if I brought Reliance shares at if I brought Reliance shares at, let's say, 2500, Reliance at 2500, okay. Now what happens if this Reliance share starts going down? Why have I brought this? I have brought this because I expect that this share to go to 2800 and then I'll sell. Tomorrow if this share starts going down from 2500 to 24 to 23, whatever. So how much risk is manageable to me? How much risk is manageable to me? That's important. So how much risk is manageable to me? Yeah, remember, always remember, bank always have their own value at risk concept. Value at risk means how much risk can we take. Generally, the banks take 4 to 5% of the stop loss. 4 to 5%, okay, not more than that. So now every bank will manage this, keep the stop loss as per their value at risk concept. Every bank will have the different value at risk or the stop loss limit, and every dealer will also have a different stop loss limit. So remember one important part, stop loss will always be triggered automatically. Stop loss will always be triggered automatically. Remember, it's not that stop loss will be triggered, has to be done manually. This is an important part about stop loss. Okay. Next one. One second. The bank fixes limits on various transactions in foreign exchange, taking into account which of the following factors. So the limits, stop loss limits and various limits are fixed on what basis? Merchant turnover requirements, trading skills and volumes, capital base and profit requirement. So based on what limits are these, based on what factors are these limits taken into account? Merchant turnover requirement. Turnover requirement means what should be the turnover. Now what turnover means, what, how much should I buy and how much should I sell? That is turnover. Trading skills. If a more experienced person is there working there, he'll be having a different limits. Whereas as a newcomer will have a different limits. Capital base. How much is the capital for the bank? Capital base means how much is the capital available with the bank. Okay. And last one is profit requirement. What is the profit requirement? So what is the answer over here? Merchant turnover, trading skills, capital base and profit requirement. So this one, profit requirement, is a really tricky one. And look at the options also. Are the options 1 to 4 all? Only the problem is this fourth one. Okay, the problem is this fourth one. Which is this? Is profit requirement the part over here to fix the limits? The answer is A, correct. It will be A. Okay, it will be A. Remember this. Answer is A. See here, profit requirement is never the consideration while fixing the limits. While fixing the limits, we have to first check the risk. Here, profit is the secondary part. First, primary part is the risk. Risk is the most important factor while deciding any limits, any banking transaction, anything. So, risk will be the main factor over here. Okay. So, 1 to 3 only. It's not the fourth one. Profit comes through the volumes. Bank always says that do more transactions and lesser margins. Okay. Nowadays in our banking also, what is happening in our banks? Nowadays the NIM, net interest margin between the banks, right? What is NIM? What is NIM, everyone? Okay, anyone knows the difference between NIM and NII? NIM and NII. Volume is too low, everyone? Is the volume too low for you all? Because I am getting it properly over here. Everyone, is the volume too low? Let me check. Hold on. It's okay, dear, because I've just now checked it with other guys also. Yeah. Volume is okay over here. Yeah, volume is good. Chalo. So what is NIM and NII? What is the difference between them? NIM and NII. Okay. See here, remember one difference is that there is a slight difference between NIM and NII. We don't understand this concept. Many of us don't understand. Many of us do understand. NII means what? It is the difference between loans, means interest on loans minus interest on deposits. Okay, that is NII. Then what is NIM? NIM means it is, understand this, NIM, understand the difference very correctly. NII, this NII what we get divided by yielding assets. Yielding assets. Now what do you mean by yielding assets? Yielding assets means those assets which are standard. No, NII is assets, always remember. NIM is upon assets. Only the point is those assets which are standard, which are giving me the interest, giving me some, it's a regular course. Those assets which have become NPA will not be the part of this NIM. Okay. So that's why I've written the specific word yielding assets. Okay, yielding, that's very important. Okay, yielding assets. This is the basic concept, and remember this NIM and NII, you will definitely get some question on this in BFM, and you need to understand the concept of this, the basics of this. Okay, chalo, move on. Which of the following statements is not correct in the context of the translation exposure? Which of the following is not correct in reference to the translation exposure? Okay, translation. What is translation firstly? What is translation? Everyone? What is translation? What is translation? Everyone? Okay, I'll give you, write it over here. Tell me what have I written it over here? What have I written it over here? Everyone, tell me. Do you understand this? Do you understand this? What have I written? No, I've written it in Chinese. Okay, Chinese. This is a Chinese. So what will you say? Sir, translate it to my language. Translate it to. Translation means what? Translating it to your language. Similarly, in Forex also. Forex also. Translation means what? I am translating the profits which I have made in the foreign currency to my local currency. Now, why do I translate? Why do I translate? The important part over here is, Suppose I am SBI, let's say State Bank of India, okay? And what am I doing? Yeah. See, a translation is always done whenever I am having some foreign currency branch, foreign branch as such. Suppose SBI. SBI is having a branch in, let's say, New York. Okay, SBI, New York is one branch of this. SBI New York is one branch. Okay, so what will SBI do in this case? Suppose on March 31st March, what will happen? SBI has to declare the profits and balance sheets, right? Balance sheets to declare the profits and balance sheets to whom? To RBI. So when they declare it, they have to declare it in rupees. But SBI New York is in dollars. So what SBI has to do, they have to take a notional rate. Notional means whatever is going on over here. Whatever is going on, presently rate. So that rate they'll take and they'll convert the profits and the figures of SBI New York. Okay, and then they'll convert it to rupees. It's reverse, dollar to INR. Translation is always dollar to INR because we want it in our currency. Okay, yeah. So that is translation. Remember, important part over here is in translation. I'll give you one important concept over here. Okay, that concept is, let me show you over here. Hold on, because there is an important point which you will see over here. That point is, there are two words, translation. Hold on. Here, understand this, huh? There are two words, translation, and second is crystallization. Crystallization. These two words are similar. In both, what do? We convert dollar to rupees. Okay, in both. Here also I do the same, and here also I do the same. Both I do the same transaction, dollar to rupees. Okay, but there is a slight difference in this. What is that slight difference? In translation, when I convert dollar to rupees, my branch in New York is running. Means I don't close down the branch. I don't close the forex transaction. So I'm not closing this foreign exchange transaction, and I'm not closing this forex branch. Whereas in crystallization, there is a slight difference. In crystallization, what happens? Whenever I crystallize any loan, I'll close down this sale. I'll close this. I close the forex transaction. So crystallization happens when I close it. When does crystallization happen? Crystallization happens when there is an NPA. In NPA, I have to convert this forex loan to my local loan. So there comes the word of crystallization. That's why I took this topic again over here, because many of you might have understood translation. So that's easy. But you have to understand the difference between translation and crystallization. Because crystallization, you will definitely get one question again in your BFM exam. Crystallization is always done for those forex loans which have not been paid. Again, they have to be converted to local currency then. Okay. So whenever we crystallize it on the TT rates. Always remember, we crystallize it on the TT rate. This is very important part again. Here, as the topic has come, I'll explain you all this crystallization concept in detail now. Okay. So crystallization is always done on TT rates. Done on TT rates. Okay. TT rates means what? They are always reverse. Suppose if I am having an export transaction, understand this now. Everyone understand this. Huh? Pay attention, everyone. Suppose if I am having export transaction. So in export, what do? I first buy the currency. Buy. Export transaction means what? Buy. Okay. And import means always sell. So in export transaction, I am buying. So crystallization of export will do what? Crystallization of export will be sell. So whatever I do over here, I'll do the reverse thing over here. Crystallization, I'll take the reverse thing, but I'll take the TT sell. Okay, I'll take the TT sell over here. So that's why, remember, crystallization is always done for those currencies. Okay, yeah, it is done for those loans which have become NPA and which we have to convert it to the local currency then. Okay, got it, everyone? Move on. what happens is, as the question comes, I explain you all the topics, because what happens, only giving you the answer is not the logic over here. Okay, only just giving you the answer is of no use. I'm having the answers with me, man. What is the problem in this? I can give you the answers offhand, all these answers, but you must understand this. The exposure of the bank affects the bottom line due to the external factors in the market, such as changes in the competition, reduction in import duty, reduction in prices, etc. So this is what type of exposure? Transaction, translation, operating and banking exposure. Now this is a bit logical also, and it's a general question also. Okay.